Welcome to chapter 11. Chapter 11 is the very last chapter that we're going to do, and I think it's probably the most fun because in this chapter we're going to learn about investing, how to invest in the stock market, how to invest in bonds, and how you can make money through investing. Okay? At the end of the chapter, we're going to talk about retirement planning. It's one of the most important things that you can learn during this semester. Okay? But in order to invest money, whether you're investing in stocks or bonds or real estate or cryptocurrency or any other type of investment, you have to have money in order to invest. And that money comes from your saving. Okay? Saving means you didn't spend the money. Saving, without an S, is the verb that says you didn't spend that money. Okay? The dollars that you saved up that you didn't spend are called savings with an S. Okay? So you don't spend money and then you take those dollars and you invest them trying to make even more money. Okay? I've been saving money for many, many years. I've taken those dollars and I've invested them to try to make even more money. And that's what we're going to learn in this chapter. Okay? Saving is important for you. It's also important for the economy. Because when one group saves the money, another group can borrow that money. And using that borrowed money, they can help the economy grow. Maybe it's me saving money at the bank and you going to the bank to borrow the money to buy a car. If I hadn't saved that money, you couldn't borrow it to buy that car. And the economy wouldn't grow because we wouldn't be able to produce those cars. Okay? Maybe Mr. Ward's hamburger stand. Okay? I need to borrow some money to open up the hamburger stand. Well, that money comes from somebody else who saved the money. Okay? So saving is very important for us as individuals, but also for the economy because it creates economic growth. Saving, the act of not spending that money, and then letting somebody else borrow it is what helps the economy grow. Okay? How do we get the money from the savers into the hands of the borrowers? Well, we call that the financial system. Okay? You know, on page 291, there's a diagram of the financial system. There are three parts to the financial system. Okay? The first is the savers. Okay? What groups typically save money? Well, households like you, me, and your parents, we save money. But also businesses. Businesses do save money. They don't spend all of their money, they save it. Okay? So individuals and households and businesses are savers. Okay? And then who borrows money? Well, we know that households borrow money. You and I might borrow money to buy a house or to buy a car or to pay for a college education. So we're going to borrow that money from somebody else who saved it. Okay? Maybe it's a business, like Mr. Ward's hamburger stand. I'm going to go to people that have saved money, and I'm going to borrow that money so that I can open up a hamburger stand. Okay? So individuals borrow money, businesses borrow money, and the United States government and other governments borrow money as well. We're well aware that the United States government borrows lots of money by buying or by selling those bonds. Okay? So the key is, how does the money get from the savers into the borrower's hands? Okay? Well, we have what's called a financial intermediary. An intermediary is a go-between or a link. Okay? So a financial intermediary is a link between the savers and the borrowers or investors. Probably the most obvious example of a financial intermediary is a bank. Banks take money from savers, you and me, when we deposit our money, and then they turn around and they loan it out to individuals to buy a house or to buy a car. They loan it out to businesses so that they can open up or expand their businesses. Okay? Banks obviously are financial intermediaries. Credit unions are similar to banks. Maybe you belong to a credit union. I actually belong to two different credit unions. What is a credit union? It's very similar to a bank. Okay? I'm a member of Schools First Credit Union. Schools First Credit Union serves as a bank for me. I can put money in there. I can get car loans and home loans from there. I can get credit cards. I have a checking account and savings account. It serves just like a bank, but one major exception. Credit unions are not trying to make a profit. That's why you're called a member of the credit union, because you're not a customer, you're a member. It's a group of people that pool their money together and then operate like a bank. For example, Schools First is a bunch of people that are involved with schools. It's made up of teachers and counselors and custodial staff, and anybody who works for a school can become a member of Schools First Credit Union. Okay? And so all of us put our money in, and then some of us take money out to borrow money to buy a house or to buy a car or to get a credit card. Okay? The big difference is because we're members, they're not trying to make a profit off of us. A bank is trying to make a profit. Credit unions do have to make some money so they can pay their employees and pay the rent on their buildings and things like that. But credit unions are not trying to make a profit off of their members. So credit unions, for you and I, are better than a bank. If you have an opportunity to join a credit union, I would strongly encourage you to do that. And everybody can join a credit union. Okay? Mine happens to be based upon being a school employee. Okay? Some of them are based upon where you live, okay? What religious affiliation you have. Okay? But you can join a credit union, and then you have access to a bank-like institution, okay? And they're not going to try to make a profit, which means you're going to get a higher rate on your savings, and you're going to pay a lower rate on your loans. Okay? And you don't have to worry about your money because credit unions are also insured. They're not insured by the FDIC. That's for the banks. They're insured by another agency called the NCUA, National Credit Union Association. And they insure your money up to $250,000 as well. Okay? So banks and credit unions, very, very similar. They're perfect examples of financial intermediaries because they take the money from savers and they loan it to the borrowers and the investors. Okay? They're the middleman in between. Okay? On page 292, they talk about some other financial intermediaries that are not banks. These are bank or bank-likes. Okay? But these other three institutions on page 292 and 293, finance companies, life insurance companies, and pension funds are also financial intermediaries because they take money from savers and they turn around and loan it out to borrowers. Okay? What is a finance company? A finance company is a company that takes money and loans it out to people. Okay? And you say, well, that's just like a bank. Yes, except that you can't deposit money at a finance company. Okay? You cannot make a deposit. You can't get a checking account. You can't get a savings account. Okay? You can't deposit money in a finance company. You can only borrow money. Okay? And finance companies, they tend to focus on people with not so good credit. If you have good credit, you'll go to a bank or credit union and you'll get a low rate loan, a lower interest rate on your loan. But if you have bad credit, you go to the bank and the bank says, yeah, no, we're not going to loan you the money. You're too risky. You might end up going to a finance company and they'll loan you the money. Okay? But they loan it at much higher rates. Okay? Maybe you've seen one of those television commercials or heard it on the radio. Come on down to Bob's car dealership. You have good credit, you have bad credit, you have no credit. We finance anybody. Okay? Well, what they're using is a finance company, and they're willing to make loans to people that don't have great credit. But in turn for that risk of people not having very good credit, they're going to charge a higher interest rate. You want to avoid going to a finance company if you can, because they're going to charge much higher interest rates. Okay? One of the things, another type of finance company now are these payday loans. Maybe you've seen one of those companies out there that if you're short of money, you can get a small loan from these payday loan companies. And what they do is they loan you money until your next paycheck. Okay? So let's say that the water bill is due and you don't have the money, but you're going to get paid on Friday. So you could go to one of these payday loan places on Monday and they'll loan you a couple $100 and then you pay them back on Friday. Okay? But because they're a finance company, they're loaning money out to people that don't have good credit, they're going to charge an awful lot. Try to avoid finance companies. Okay? Sometimes they're okay. If you're going to buy like furniture and things like that, sometimes they'll offer decent rates on that. Okay? But these other two I want to spend a little bit more time with. Okay? What is life insurance? Well, life insurance is insurance on your life. Okay? All types of insurance, auto insurance, health insurance, homeowners insurance, okay, or life insurance, are all designed to protect you from financial loss. For example, I have car insurance. So if I get in a wreck, then I don't have to worry about losing a lot of money because the insurance company will pay me back for pay to fix my car if it gets damaged, or to fix the other person's car if I damage their car. Okay, if I have health insurance, I know that if I have to go to the hospital, that my bill is going to be paid by my insurance company. Okay? Well, what is the purpose behind life insurance? Okay? Life insurance is designed to financially protect the people that you are leaving behind. Okay? For example, my son and daughter-in-law, they recently had a baby. I have a granddaughter. She's about 3 months old now. Okay? If my son were to die, how would his family's financial futures be impacted? They would be impacted a great deal. Okay? He's the one that makes the most money in the family and so forth. What would they do to pay the rent and pay for my granddaughter to go to college and all those other expenses? So my son has life insurance. I have life insurance. Okay? Many people that have families have life insurance. So if something goes bad and that person dies, that their families are financially protected. Okay? How does life insurance work? Well, there are two basic types of life insurance. Two basic types of life insurance. Okay? There's what they call term insurance and whole life insurance. That's a test question. What are the two types of life insurance? Term insurance and whole life insurance. Okay? With term insurance, this is the most popular type of insurance. Okay? With term insurance, you're insured for a certain period of time. Okay? Most term insurance policies are for 10 years. Some are for 20 years. Some are for 30 years. I happen to have a 20-year policy. My son recently got a 30-year policy. Okay? The reason it's called term insurance is because you're only insured for that term. Okay? So I have life insurance for the next 20 years. Actually, it's not quite 20 more years because I've had it for a number of years now. But I'm insured for a 20-year term. Okay? You then have to decide how much money you want your beneficiary to get. Okay? And that's an important word. Beneficiary is the person that gets the money when you die. Okay? My wife is the beneficiary on my policy. Okay? My mom has a life insurance policy, and since my dad has passed away, the kids, my brother and my two sisters and I, we're the beneficiaries. So when my mom dies, we will get some money. Okay? A term policy for 20 years. How much money do you want your beneficiaries to get? Okay? That's a common amount, $500,000. Okay? My policy happens to be a 20-year policy for $500,000. So if I die within that 20-year term, if I die within that 20 years, Mrs. Ward gets $500,000. And you say, Mr. Ward, that's an awful lot of money. Well, yes, but I've had the policy for quite a while. And the reason I got so much money was because I wanted it to be able to support my wife and children if I died when they needed that money. That money was going to pay off the house. It was going to pay for my children's college education. It would help pay for my daughter's wedding and so forth. I wanted Mrs. Ward to have that money so that if something bad happened, she could still provide for herself and for my children. So how much does something like that cost? The cost of insurance is called the premium. That's the cost that you pay for that insurance. For me, it's about $40 a month. Now, I don't actually pay every month. I just pay once a year. I pay $450 a year. So that's even less than $40 a month. So I pay only $40 a month or $450 a year for $500,000 worth of protection. So that if I die, Mrs. Ward would get $500,000. And if Mrs. Ward is dead, my children would get to split up that $500,000. And you might think, well, Mr. Ward, how does the insurance company make any money? $450 a year is what I pay. $450 a year. If I pay for 20 years, that's only $9,000. That's only $9,000. So I'm going to give the insurance company $9,000 and they're going to pay Mrs. Ward $500,000. Well, what's the catch? I have to die within that 20-year term. If I don't die within the term, then Mrs. Ward gets nothing, and the insurance company gets to keep all $9,000. And in fact, that's exactly what the insurance company is banking on. The insurance company is banking on the fact that I'm not going to die within that 20-year period. Okay? I got my life insurance when I was 45 years old. So at that time, okay, I was a 45-year-old male, non-smoker, relatively good health, okay? And so I was able to get a pretty cheap policy, $450 a year. But they said, how many 45-year-old guys are going to die in the next 20 years? Not that many. So the insurance company was willing to take that risk. Okay? So term insurance, term life insurance, is the most popular, okay? I happen to have a 20-year term. My son just recently got a 30-year term, okay, because he's planning to buy a house, and so he wants to have enough money over the next 30 years to guarantee that my daughter-in-law, my granddaughter, and any other future grandchildren that I have, that they're financially protected. Okay? So term insurance is the most common, but you have to die within the term in order for them to pay out. There's another type of insurance called whole life insurance. With whole life insurance, you pay for, well, your whole life. You pay for the rest of your life. So if I got the policy at age 45, I would pay every month until I died. At 65, 75, 85, 95 years old, I would keep paying. Okay? To get the same $500,000 worth of coverage, so that if I die, my beneficiary, Mrs. Ward, would get $500,000. It would cost like $400 a month. Why would it cost so much more money? You have to pay for the rest of your life. Why would they charge you so much? Because they know they're going to pay out. With this type of insurance, term insurance, they're banking on the fact that you're not going to die within the term. And in fact, less than 1% of all the people that have term insurance die within the term. Most people do not. And so the insurance companies end up making money. With whole life insurance, they know they're going to pay out because everybody dies eventually. Okay? So they charge you a lot more money. Okay? All right. I know that's more than you probably needed to know about life insurance. Especially at your age, you're probably thinking, Mr. Ward, why do I need life insurance? You don't. You do not. Unless you have a child or someone else that is relying on you for their financial support. Okay? You don't need life insurance. One of my other sons, okay, he's not married. He doesn't need life insurance. Okay? Nobody is relying on him for financial support. But my son that's married and has a baby, he does need life insurance, and so he has it. Okay? But someday you're probably going to be in that boat, so I want you to know and understand the basics of life insurance. Okay? How does life insurance work as a financial intermediary? Okay? Well, all the money that you pay in premiums, whether you're paying $40 a month, $400 a month, $450 a year, whatever premiums that you're paying. My son pays over $1,200 a year in his premiums. He has a huge policy though. He has a huge policy. But at any rate, the premiums that you pay, what does the insurance company do with all that money? Well, they turn around and they loan it out. The insurance company, the life insurance company, gets the money in premiums, and then they turn around and loan it out. They buy government bonds. They loan it out to businesses. They invest it as investors in the stock market and other bonds and other investments. Okay? So they serve as a financial intermediary because they take money that's saved by me and other people that have life insurance, and then they invest it. So life insurance is a financial intermediary, okay? And there is a test question on the two different types, okay? All right. The next one is a pension fund. What is a pension? Well, later on in this chapter, we're going to talk about retirement. And you're probably thinking, Mr. Ward, I'm 17, 18 years old. I don't even have a job. How can I worry about retirement? Well, someday you will have a job and you'll want to start thinking about retirement. Okay? And we're going to spend some time the last week of classes talking about retirement. Okay? But one of the things that you can get from your job for your retirement is called a pension. Okay? As a teacher, I get a pension. Okay? What is a pension? It's money you get when you retire. Okay? Social Security is an example of a pension. It's a government pension because you're going to get that money month after month until you die. Well, as a teacher, I get a pension provided by the State Teachers Retirement System. We often refer to it as STERS, the State Teachers Retirement System. Okay? Every month when I get paid, the State Teachers Retirement System takes money out of my check. Just like with Social Security. They take money out while you're working. Okay? Your employer, in my case, Charter Oak Unified School District, they also kick in. Okay? So the employee and the employer kick in money. They make contributions. And then, when I retire, they will give me a pension. Okay? Pensions are really popular in the public sector. Public school teachers, police officers, firemen, postal workers. Okay? Some other industries also provide private pensions, but government pensions are the most popular. So if you work for the government, again, as a police officer, fireman, and so forth, okay? I happen to work for the California State Teachers Retirement System. Okay? So I put in money, Charter Oak Unified School District contributes money, and then when I retire, I get a pension. Okay? My pension, and most pensions, are based upon three factors. how many years of service do you have? Okay. The more years of service, the bigger your check. The bigger your check is. Okay. If I've only been teaching for 10 years and I retire, or if I've been teaching for 40 years and I retire, obviously a 40-year teacher is going to get more money because they put in more money as well. Okay. Your age at which you retire. Like Social Security, your pension is going to keep paying money out until you die. Okay. My father-in-law was a public school teacher, and he retired at age 62. He died at age 86. So for 24 years, he was collecting a pension from the state teachers retirement system. The older you are, the more money you get because, in theory, you're closer to dying. If you retire at 55 or you retire at 65, they're going to give you more money if you're older. And then, of course, your salary. Your salary. Okay. Your years of service, the way my pension works, my years of service and my age help to create what we call my age factor. Okay. If you work until you're 62, okay, you get an age factor of 2.4%. That's the maximum. The maximum is 2.4%. Okay. So to figure out my pension, okay, we take the number of years that I've been working, that I've been paying into the system, times my factor, my age factor, whatever it happens to be. Now I'm going to retire earlier, so I won't get 2.4. I'm going to retire before I'm 62. So I'm going to get a lower number. Okay? But let's say that you're a young teacher, okay? And you decide you're going to work for 40 years. I remember when Mr. Grund was a first-year teacher, he and I used to share a classroom. He would use my classroom a couple periods a day, okay? And I remember when he started out. So he's been teaching a long time already. So let's say he puts in 40 years and he gets to age 62. Okay? Got to get to age 62 to get there. Okay? Well, 40 years times 2.4% is 96% of his salary. That's pretty good. That means when he retires, when he stops teaching, he's going to get 96% of his highest salary for the rest of his life. So imagine you make $100,000 a year. You're going to get $96,000 every year for not working. A pension is a pretty good thing. Okay? My brother-in-law is retiring. He was the captain of the San Dimas Sheriff Station. He was the head guy at the San Dimas Sheriff Station. Okay? And he's retiring at age 57. Okay? He's going to get like 90%. He doesn't quite get 96 because he's not 62 or whatever. But he's going to get like 90% of his salary for the rest of his life for not working. I don't know about you, but that sounds like a pretty good deal. In fact, a pension is a great thing. Okay? When you go to retire, and we're going to talk more about retirement planning right toward the end of the semester, the last week, but when you go to retire, what are you going to do for money? Well, if you have a job like I have, you get a pension, and you get money month after month after month, year after year after year until you die. And you can never run out of that money. Mm-hmm. That's a beautiful thing. Mm-hmm. A pension fund is a financial intermediary. Okay? Every month, both you and your employer are contributing money to this fund. As savers, you're putting money into the pension fund. And then what does the pension fund, what does the state teachers retirement system do with all that money that they collect every month? Well, they don't just sit on it, they loan it out. They buy government bonds. They invested in the stock market. They invested in corporate bonds and other types of investments, because they're going to take the saved dollars and they're going to invest those dollars and loan those dollars out. That makes them a financial intermediary. All right. So, a pension is on your test as well. Okay? A pension is a monthly payment that you get when you retire. All right, now let's get to the fun stuff. We're going to start talking about investing, okay? But that'll be in the next video.